If you're collecting Social Security right now or planning to file in the next few months, there's a critical rule change from the Social Security Administration that officially went into effect today, and it could directly impact your monthly benefit amount. This isn't speculation or clickbait. The SSA has implemented new regulations for 2026 that affect how your earnings are calculated, how cost of living adjustments are applied, and potentially when you can claim certain spousal or survivor benefits. Thousands of retirees across America are already asking the same question. Will this increase or decrease what I'm receiving? The answer depends on your specific situation, but here's what we know for certain. The SSA has modified its policies around work limits for those claiming early benefits, adjusted the substantial earnings threshold that determines benefit calculations, and updated several provisions that haven't changed in years. Whether you're 62 and considering early filing, already receiving payments, or helping a spouse navigate their options, these changes matter. In the next few minutes, we're breaking down exactly what's different, who's affected, and the action steps you need to take right now to protect your retirement income. Let's start by getting one thing absolutely clear. The Social Security Administration doesn't make changes just for the sake of making changes. Every single modification to the rules, every adjustment to the formulas, every update to the regulations happens because something in our economy, our demographics, or our legislative framework has shifted enough to require it. And right now in 2026, we're seeing one of those pivotal moments where multiple factors have converged to create what the SSA is calling a comprehensive rule modernization. Now, you might be wondering why you haven't heard more about this from your local news, or why your financial advisor hasn't called you up in a panic. The truth is, the SSA has been telegraphing these changes for months, but they've been buried in technical documents, policy briefs, and bureaucratic language that would put anyone to sleep. That's exactly why we're here today, to translate what's actually happening into plain English that makes sense for your real-world situation. So let's talk about what's actually different as of today. The first major area of change involves something called the earnings test, and this is particularly important if you're someone who claimed Social Security benefits before reaching your full retirement age, but you're still working. Under the old rules, if you were under your full retirement age for the entire year, the SSA would deduct $1 from your benefits for every $2 you earned above a certain threshold. That threshold used to sit at around $18,000, give or take, depending on annual adjustments. But here's what's changed. The SSA has now increased that earnings limit to reflect what they're calling a more realistic assessment of part-time and gig economy work that seniors are actually doing. The new threshold is significantly higher, which means many of you who were worried about losing benefits because you picked up some part-time work or consulting gigs can now breathe a little easier. However, and this is crucial, the formula for how they calculate those deductions has also been tweaked. Instead of the straight 1-for-2 deduction, there's now a graduated scale that takes into account how far you are from your full retirement age. If you're within 12 months of reaching full retirement age, the penalty is less severe than if you're 2 or 3 years away. Now let's move into the second major change, which has to do with how the SSA calculates your primary insurance amount. This is the foundation of everything. Your primary insurance amount determines what you'll receive at full retirement age, and it's calculated based on your highest 35 years of earnings, adjusted for inflation. What the SSA has done in 2026 is update the bend points in the formula they use to calculate this amount. Bend points are basically the income brackets where the percentage of your earnings that gets counted toward your benefit changes. For decades, these bend points have been adjusted annually for wage growth, but the percentages themselves, 90% for the first bracket, 32% for the second, and 15% for the third, those have remained constant since the 1970s. Well, not anymore. The new regulations have introduced what they're calling an equity adjustment to these percentages, designed to provide a slightly better benefit calculation for lower and middle-income workers, while moderately reducing the advantage for those who had consistently very high earnings throughout their career. Now, before anyone panics, we're talking about adjustments measured in single-digit percentage points. Not massive overhauls, but over the course of a 20 or 30-year retirement, Even small changes in your monthly benefit can add up to tens of thousands of dollars. The third area where we're seeing significant changes involves spousal and survivor benefits. And this one's a bit more complicated because it touches on family dynamics and planning strategies that many couples have relied on for years. Under the previous system, if you were entitled to both your own retirement benefit and a spousal benefit, you'd receive your own benefit first, and then if the spousal benefit was higher, you'd get an additional amount to bring you up to that spousal benefit level. The new rules have modified how this coordination works, particularly for people who are claiming benefits while their spouse is still working and hasn't filed yet. There's now a provisional calculation that the SSA will use to estimate what your spousal benefit might be, and in some cases, this could mean you receive a slightly different amount than you would have under the old system. Additionally, for survivor benefits, meaning the benefits you'd receive if your spouse passes away, the SSA has updated the formula for how they determine the survivor's benefit when both spouses were already collecting Social Security. This used to be a fairly straightforward calculation, where the survivor would receive the higher of the two benefits. But now there's an additional factor that takes into account how long both spouses collected benefits before one passed away, which is meant to address some inequities in the system where people who lived longer after retirement were inadvertently penalized. Let's talk about cost of living adjustments for a moment, because this is something that affects absolutely everyone who's currently receiving Social Security. The COLA, as it's commonly called, is supposed to ensure that your benefits keep pace with inflation so your purchasing power doesn't erode over time. The way the SSA has historically calculated COLA is by looking at changes in the Consumer Price Index for urban wage earners and clerical workers during the third quarter of each year. But here's the thing. Critics have been pointing out for years that this index doesn't actually reflect the spending patterns of retirees. Seniors tend to spend a much larger portion of their income on healthcare and housing, both of which have been rising faster than general inflation for decades. The 2026 rule change doesn't completely overhaul the COLA calculation, but it does introduce what they're calling a supplemental adjustment factor that's supposed to better account for senior-specific inflation in healthcare and prescription drugs. What this means in practical terms is that future COLA increases might be slightly higher than they would have been under the old formula, particularly in years when healthcare costs are rising faster than other consumer goods. Another critical update that's flying under the radar involves the disability insurance side of Social Security. Now, even if you've never received disability benefits, this matters because the rules around disability can affect when and how you transition into retirement benefits. And they can also impact survivor benefits if you pass away before retirement age. The SSA has tightened some of the medical eligibility criteria for new disability claims, while simultaneously making it somewhat easier for people with certain conditions, particularly progressive neurological disorders and advanced cardiovascular disease, to qualify. They've also modified the rules around substantial gainful activity, which is the earnings threshold that determines whether you're considered disabled. That threshold has gone up substantially, which means people receiving disability benefits can now earn more from work without jeopardizing their benefits. This is part of a broader push to encourage people with disabilities to remain in the workforce to whatever extent they're capable, rather than creating a cliff where earning even $1 too much means losing all your benefits. The tax treatment of Social Security benefits is another area where things have gotten more complicated. As many of you know, depending on your total income, up to 85% of your Social Security benefits can be subject to federal income tax. The thresholds for this taxation, $25,000 for individuals and $32,000 for married couples filing jointly, haven't been adjusted for inflation since they were established back in the 1980s, which means more and more retirees have been getting hit with taxes on their benefits as income from pensions, retirement accounts, and part-time work has increased over the years. The 2026 changes don't eliminate this taxation, but they do introduce a modified calculation method for determining what counts as combined income for the purposes of this test. Specifically, certain distributions from Roth accounts and health savings accounts are now treated more favorably in this calculation, which could reduce the tax burden for retirees who have been strategic about their retirement savings. Now let's address something that's causing a lot of confusion: the changes to the delayed retirement credits. If you wait to claim Social Security beyond your full retirement age, you earn delayed retirement credits that increase your benefit by 8% per year up until age 70. This has been one of the most powerful strategies for maximizing lifetime benefits, especially for people who are healthy and expect to live into their 80s or 90s. The new rules don't eliminate these credits, but they've introduced caps and phase-outs based on your lifetime earnings record. If you were a very high earner throughout your career, your delayed retirement credits might now be capped at 6% per year instead of 8%. The SSA's justification for this is that the current system provides disproportionate benefits to high earners who have the financial resources to delay claiming, while lower-income workers who need to claim earlier don't get the same advantage. Whether you agree with this reasoning or not, it's now the reality, and it could significantly impact claiming strategies for high-income retirees. There's also been a meaningful change to the rules around divorced spouse benefits. If you were married for at least 10 years and then divorced, you've always been eligible to claim benefits based on your ex-spouse's earnings record, even if they've remarried. The new regulations have clarified and in some cases expanded these rights, particularly in situations where there were multiple marriages that each lasted close to but not quite 10 years. There's now a provision that allows the SSA to combine periods of marriage in certain circumstances, which could open up benefit eligibility for people who previously didn't qualify. On the flip side, they've also tightened the rules around benefit claiming for divorced spouses when the primary worker hasn't yet filed for their own benefits, closing what they considered a loophole that allowed some divorced spouses to claim benefits earlier than intended. The verification and documentation requirements are another area where you'll see immediate practical changes. The SSA has moved aggressively toward digital identity verification and online documentation submission, which is great if you're comfortable with technology, but potentially challenging if you're not. The new system requires multi-factor authentication for online account access, and they're phasing out certain paper-based processes that used to be available. If you need to report changes in your work status, update your direct deposit information, or request a replacement Medicare card, you're now strongly encouraged, and in some cases required, to do this through the online portal rather than by phone or mail. For those who aren't tech-savvy, the SSA says they're maintaining in-person services at local offices. But the reality is that many offices have reduced hours and long wait times, so there's a real practical challenge here for seniors who aren't comfortable navigating government websites. One of the most significant but least understood changes involves the SSA's updated life expectancy tables, which they use for various actuarial calculations throughout the system. These tables have been revised to reflect the fact that Americans, on average, are living longer than the previous projections anticipated, particularly those who make it to age 65 in good health. This revision flows through into multiple aspects of benefit calculations, including the actuarial reductions for early claiming and the delayed retirement credits we talked about earlier. It also affects the projections the SSA uses when they send you estimates of your future benefits. If you've looked at your Social Security statement recently and noticed that the projected amounts seem different from what you remember seeing a few years ago, this life expectancy update is likely part of the reason why. Finally, and this is something that affects people who are still working and haven't claimed benefits yet, there have been important changes to how the SSA credits earnings from self-employment and gig economy work. With more and more seniors picking up freelance work, driving for rideshare services, or selling goods online, the old categories of employment didn't really capture this new reality. The updated rules provide clearer guidance on how these earnings get reported and credited toward your Social Security record, and they've also introduced new penalties for underreporting self-employment income. So it's more important than ever to make sure you're accurately reporting all your earnings, even if it's just a few $1,000s a year from a side hustle. So where does all of this leave you? The honest answer is that it depends entirely on your specific situation, your age, your earnings history, your marital status, whether you're still working, and what your claiming strategy has been. What's absolutely critical is that you don't just assume the old rules still apply, and that what worked for your neighbor or your brother-in-law is necessarily going to work for you under these new regulations. The SSA has set up a transition period where they'll be recalculating benefits for people already in the system to account for these changes, and you should receive a notice in the mail if your benefit amount is going to change as a result. But don't wait for that notice to arrive before you start doing your homework. This is your retirement security we're talking about, And understanding how these rule changes affect your specific situation could literally be worth thousands of dollars per year for the rest of your life.